Hello students, uh, welcome to our today's new session which is about IAS 7 statement of cash flow. What is the expected accomplishment of today's session? We will discuss what is the objective of this standard, what is statement of cash flow. Then we will talk about what is cash and cash equivalents. Then we will talk about methods to prepare statement of cash flow. Then we'll talk about source data to prepare statement of cash flow. Then we will talk about what is the performer to prepare statement of cash flow under indirect method. Then we will talk about advantages of statement of cash flow and disadvantages of statement of cash flow. Meanwhile, we will talk about uh, the different workings which we are supposed to do. That is the major area of today's discussion. Now, at the end, as usual, we will solve some past exam questions. Okay. What is the objective of this standard? IAS 7 objective is to require the presentation of information about historical changes in what cash and cash equivalents of an entity by means of statement of cash flow. What we will do, we will prepare statement of cash flow. By using that statement of cash flow, we will present the information related to changes in cash and cash equivalents. These cash flows can be classified according to their activities, which is cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. So we will bifurcate, we will reclassify our cash flows into three categories: operating activities, investing activities, and financing activities. Now, uh, what are the key discussions under these different activities, statement of cash flow, how it works? First of all, we have operating activities. Under operating activities, we will deal with sales of goods or rendering of services and royalties, fees, and commissions and other operating expenses. We will deal about these areas under operating activities. And under investing activities, we will talk about PPEs, addition, disposal, intangibles, equity, debt instruments, investment, or future forward swaps, options, investments. And in the last area, which is about financing, that would be about issuance of shares, issuance of bonds, or redemption of bonds, or about finance lease. Okay. Now, what is cash and cash equivalent? First of all, cash. The cash which you have in the physical form, in form of cash on hand, and the demand deposit in your bank. If you have fixed deposit in your bank, that would not be your cash. And what is cash equivalent? That is short-term investment. What is meaning by short-term investment? Investment for less than 90 days. That is called short-term investment. So this investment can be converted into cash on demand. So these are called cash and cash equivalents. Okay. Now we have discussion about methods to prepare statement of cash flow. There are two methods. One is called direct method and the other is called indirect method. Now, examiner has specifically discussed in your syllabus outline that for paper financial reporting, indirect method would be examinable, direct method would not be examinable. So it means in our 2 day session, we will talk about what? About Indirect method. What is the source data to prepare statement of cash flow? This is the important thing. Look, we have two major source data. First of all, statement of profit and loss, that would be current year, and then we have statement of financial position. Now, under statement of financial position, we will use preceding year statement of financial position as well as current year statement of financial position data. Now, keep in mind, all these financial statements are prepared on accrual basis of accounting. These are prepared on which basis? Accrual basis. What is meaning of this? It means that in these financial statements, transactions are recorded or events are recorded when they occurred, irrespective of cash at that time involved or not. Okay. But here we are supposed to prepare statement of cash flow, which is based on cash basis. So it means it is our attempt to convert the data which we have on accrual basis into the data which will be on cash basis. Okay. Now, what is the pro forma? This is important thing. You must have to cram your pro forma under indirect method, because we have discussed earlier, direct method is not examinable. Number one, first discussion is about cash generated from operations. So this is the pro forma, and I will discuss item by item basis. But we will get profit or loss before tax. We will get PBT from where? From current year statement of profit and loss. Then we will do some adjustments. Here, rule of thumb is expenses nature items will be added. Why? I will talk about later. And revenue nature items will be subtracted. Okay. Now, there are two possibilities, that some expenses and some revenues are non-cash. We are supposed to make their adjustments. Then there is another possibility that some items are supposed to not be treated here. For instance, depreciation is an expense which is non-cash item. So it is an expense, so it will be added back, because it is expenses who has reduced your profit, but against that expense you don't have any cash outflow, means you don't have make any payment. So that's why we are adding back that. Then loss on disposal. Look, for accrual basis of accounting, IAS 16 says that you are supposed to calculate gain or loss, which is non-cash item. The cash which you are receiving against the sale of your asset, that is sales proceeds. That will be dealt under investing activities. So this loss or gain is non-cash item. If it is loss, it will be added back. And if it is gain, it would be subtracted, because it have increased your profit or decreased your loss, but you don't have actually inflow of cash against that gain. Okay. So that will be, loss will be added back, and if you have gain, it will be subtracted. Now it will depend upon the nature of data. Sometimes you are supposed to calculate it, sometimes it will be given in your statement of profit and loss. Then we have finance cost. Again, finance cost, which is expense that is based on accrual basis. Actual how much interest you have paid, that is something separate. So we have added back. Then investment income. So how much you have received, cash received against that income, that would be inflow under investing activity. But here, that investment which is recorded on accrual basis, you are supposed to subtract, like that government grant amortization, how much grant you have received, that is separate, but the grant which you have recorded as your income, that is separate. So grant received will be considered somewhere else, but here what we will do, we will subtract the amount of grant which we have recognized as income. Now, then if there is an increase in provision or decrease in provision, now all current liabilities related items, if liabilities will increase, there is a deferment of payment. It means you have inflow. And if your liabilities will decrease, it means you have made more payment, that is your outflow. So provision increase, added back, and decrease subtracted. Again, accrual income, increased added back, and decrease subtracted. Prepayments, that is now asset. Asset have inverse nature than your liabilities. If prepayment increase, there is increase in asset, it means your cash is tied up, so you have subtracted. And if there is a decrease in your prepayments, that will be added back. Then again, working capital adjustments, these are the three things: inventory, debtors. So if there is increase in inventory or debtors, that will be subtracted, and if there is a decrease, it will be added back. And creditors, because it is liability, opposite to this, the increase in creditors added back and decrease deducted. After that, the item which you got, that is cash generated from operations, which could be inflow or outflow. If it is inflow, it will be positive figure. If it is outflow, it would be negative figure. Then cash flow from operating activities. Now, cash generated from operations we have calculated in previous slide. There are two things: interest actual paid, we have added back finance cost. As I discussed earlier, that there is a possibility that the interest which is actual paid, that would be different from the finance cost. We are supposed to subtract it. And then tax paid, we are supposed to subtract it. Why we did not added back actual tax expense? Because we have used profit before tax. If you are using profit after tax, then you will add back tax expense in your operating activities. We subtracted these two from cash generated from operations. Then this is the net cash flow from operating activities, inflow or outflow. Keep in mind, in today's session, my major focus would be on section A and section B questions. In another session, I will talk about section C, how to solve section C question of statement of cash flow. Then we have cash flow from investing activities. Here, the purchase of non-current asset, that would be subtracted, it is outflow. Sale proceeds on sale of non-current asset or on disposal of non-current asset will be added back, that is inflow. Proceeds from government grant, That is inflow, investing activity here. Actual grant received. Grant income which you have recognized, we have subtracted in cash, cash generated from operation heading. Then interest received on debt investment. This is your interest income against that you received, what you actually received. You have subtracted your income over there. And then dividend received on equity investment will be added back. And after that, net result would be net cash flow from investing activities. Then we have cash flow from financing activities. Here we have proceeds from issuance of shares, that is an inflow. Proceeds from issuance of bonds or loan notes, that is an inflow. There now, shares is irredeemable investment. Company is not supposed to repay against it. But bonds or loan notes, or which is called debentures, these are redeemable. Possibility that these are redeemable. Shares could be redeemable if these are preference redeemable shares, but that will be treated like bonds or loan notes. When we are making the repayment, that is an outflow. Then dividend payments, that is outflow. And payments against lease liabilities, that is outflow. Then net result would be net cash flow from financing activities. It could be either cash inflow or cash outflow. Now, one thing which is important, what is the major difference between indirect method and direct method? Cash flow from financing activities same, cash flow from investing activities same, cash flow from operating activities calculated in a different way. But as I discussed earlier, that examiner categorically says that for paper FR only indirect method is examinable. Now, then reconciliation of cash flow statement. Net cash flow from operating activities, net cash flow from investing activities, net cash flow from financing activities. Then we have net cash flow for the period. Then opening cash and cash equivalents we have, and then closing cash and cash equivalents will be calculated. Now, in structured questions, section C question, it is very easier to check whether you have prepared statement of cash flow in a correct way or not. Like these two items will be given to you in your statement of financial position. It would be in preceding year SFP, and this would be in your current year SFP. You would be able to recognize, if by recognizing you are getting reconciliating, you are getting this figure, it means your cash flow statement is correct. Now, what are major adjustments and how to calculate? First important calculation is about how to calculate interest paid. It can be constructed in T account form. It can be constructed in tabular form. So I preferred a tabular form. Balance brought forward, which we will get from preceding year SFP. Finance cost from where? Statement of profit and loss. Unwinding of discount, there would be information about this in any adjustment. And balance carried down from SFP. By doing this working, these two things, we will subtract these two, we will add, we got interest paid. These performance are also very important, because in your section A and section B, examiner will test your such like these workings. Then we have tax paid adjustment, which is balance brought down, which would be in SFP, both current and deferred. This is important. You will add both deferred taxation as well as current taxation. Then tax charge in SPL, you will add back deferred taxation on PPE revaluation. If there is any deferred taxation related to revaluation of PPE, you will add back and you will subtract balance carried down and the balancing figure would be your tax paid. Then we have adjustment lease liabilities paid. Again, current and non-current both you will add back. Opening balance, new lease addition if there is any, balance carry down, closings you will subtract, and the remaining figure would be lease liabilities payment. Okay. Then dividend paid, balance brought down, from where we will get retained earnings, which would be given to us in your SFP or in statement of changes in equity. And then profit for the year, we will add back, and then we will subtract the closing balance of retained earning. It would be also in your SFP. Okay, but the most important thing is opening balance would be always from preceding year financial statement of financial position, and closing balance would be from current year statement of financial position. The balancing figure would be your dividend paid. Then we have issuance of shares. Number one, balance carry down both. Again, we will add back, add the both ordinary share capital and share premium, and closing balance. Again, ordinary share capital and share premium. We will subtract and remaining cash received against issuance of shares. Now, one important thing, that there is possibility that you may have bonus issuance of shares. I have talked in detail in lecture about EPS, about bonus issuance, right issuance. This is non-cash issuance. But most of the cases for bonus issuance, which reserve is used, that is share premium. Okay. So its adjustment is very simple. Because its journal entry would be share premium account debit to share capital account credit. Now look, by doing this, you are just revising the balance of share premium and share capital. Overall figure of these two will be same, and we are adding here the two figures. So that's why we will ignore that adjustment. But there is one possibility, exception is this, that examiner may ask you that you issued the bonus issuance against retained earnings by using the retained earnings. In that case, there is a possibility of adjustment to calculate cash received. So from closing figure, the issuance through retained earnings figure will be subtracted here, and adjusted figure will be shown here, and after that we will calculate cash received against issuance of shares. Okay, now there is an other adjustment, which is issuance or redemption of bonds. Now, opening balance, which will be in SFP of preceding year, and closing balance, which would be we will take from current year SFP. We will compare it. If at the end you have positive figure, then it is cash received, means your closing balance is less than opening, and if it is negative, it means you have cash paid. Then the most important adjustment about PP. Keep in mind, PP is very important adjustment. Why? First of all, we are supposed to give one figure, add back depreciation. If you have disposal, then either subtract in your cash flow from cash generated from operation, And then we are supposed to calculate under cash flow from investing activities whether there is a purchase of non-current asset or sale proceeds from the sale of non-current assets. So in that case, it would be balancing figure. Either carrying value we will calculate how opening balance, which would be carrying value. Carrying value means cost minus accumulated depreciation. In this performance we will use this. Then if we have addition we will add, if we have revaluation we will add, if we have disposal we will subtract, and depreciation amount we will subtract, and this is the carrying value. Now most of the cases examiner will ask you to calculate addition. In that case we will put all the other figures in pro forma, and this would be your balancing figure. Or if disposal sale proceeds required, then it would be your disposal figure. Then disposal of PP, over there we are supposed to calculate major thing, gain or loss. If sale proceeds are greater than your carrying value, then there is gain. Carrying value of disposed asset. Okay. And then we have gain on disposal or loss on disposal. So usage of these performance will depend upon what sort of the data you have in your question. Okay. Then what are the advantages of statement of cash flow? It may assist user of financial statements in making judgments on the amount, timing, and degree of certainty of future cash flows. Word is it may assist, because you are preparing statement of cash flow by using historical data. So it will just give you the previous history pattern from where you will only use your judgment to ascertain the things about future timing of cash flow, cash amounting of cash flows, and degree of certainty of future cash flows. So it is just as being an assisting tool. It gives an indication of relationship between profitability and cash generating ability. This is important. Look, in the short run, business can survive without profit, but business cannot survive without cash. Your sales revenue figure is very high, your profits are very good, but your majority sales are on credit. It means you are not receiving sales cash against your sales. So it means this relationship is not strong, and thus the quality of profit earned, whether these profits are in the form of cash or not. Then an analyst and other user of financial information often formally or informally develop models to assess and compare the present value of future cash flows of entities. Historical cash flow information could be useful to check the accuracy of past assessment. Now, look, this is the work of financial analysts to predict future cash flows, and when you are starting any project, that is to assess the financial viability of the project or not. After that, your actual performance occurred and you have actual data. So by using that data, you can compare and assess whether the estimates those were made by your analysts were correct or not. And in the light of that assessment, you can predict your future also. A statement of cash flows in conjunction with statement of financial position. It means along with statement of financial position provides information on liquidity ability, means how much liquid form cash we have, viability and adaptability. Liquidity, viability means whether it is viable for you to convert your revenues into cash or not, or how much you are adaptive according to the needs requirements. The statement of financial position is often used to obtain information on liquidity, yes, but the detailed analysis of that information is done through statement of cash flow. So statement of cash flow is used as a supportive document to assess the liquidity position which you have in your statement of financial position. For example, over there you have figure of your cash equivalents or cash, okay, but how there was a movement in the previous one accounting period on about your cash flow, that will be ascertained by using statement of cash flow. Okay, then cash flow cannot be manipulated easily and not affected by judgment or by accounting policies. You know that sometimes different standards allows you to different accounting policies. So it's not a violation of principle and rule. Even though by using different accounting policies, you may be able to alter your profits, but that will not affect your cash flows. So that's why cash flow statement information is considered more accurate. There is no window dressing in that information. Now, what are the limitations of, sorry, this is a typo mistake. It is a limitation of statement of cash flow. This is, sorry, this is limitation of statement of cash flow. A statement of cash flow are based on historical information and therefore do not provide complete information for assessing future cash flows. It is just giving you the hint, the pattern, but it will not you give the accurate information to assess future cash flow because it is based on what? Historical information. There is some scope of manipulation of cash flows. For example, delaying tactics could be used by making the payment to your suppliers at the end of the year. It means there is what the realistic cash outflow could be. You may have delayed and you have made some manipulation, but rare chances. Cash flow is necessary for survival in short term. Yes, as I discussed earlier. In order to survive in long term, a business must be profitable. Short term survival is based on liquidity position, and long term survival is based on your profitability. So it is sometimes necessary to sacrifice cash flow in short term in order to generate profits in the long run, like by making investment in non-current assets. So you have sacrificed your liquidity to generate cash in the long run. So it means if you have huge cash balance, it is not a good sign of management. It means you have idle cash. It means you are improving your liquidity position on the expense of your profit. One thing which you will learn in your paper financial management, that there is inverse relationship between what? Liquidity and profitability. There is inverse relationship between liquidity and profitability. Now let's start the exam questions. First one, following information is available for the property, plant and equipment of FRI as at 30th September 20x4 and 20x3 carrying value. Now look, this is current year data and this is preceding year data. The following items were recorded during the year ended 30th September 20x4. Depreciation charge of 2.5 million. An item of plant with a carrying amount of $3 million was sold for $1.8 million. A property was revalued upward by $2 million. Environmental provision of $4 million related to PPE were capitalized during the year. What would amount would be shown in prior statement for purchase of PPE? So this is against addition. Now, what is opening balance? What performer we have used, that is balance brought down, which is in thousands, 23,400 plus addition plus revaluation minus disposal minus depreciation plus provision because it was capitalized equals to closing balance, balance carried down. Now, they are asking us to calculate addition. How much revaluation? First of all, we have this, sorry. There is a mistake. Opening balance was preceding year balance, which is this one, 2003, 14,400. Okay. Now closing balance is 23,400. Depreciation charge is given to us 2,500. Okay. Then carrying value of assets sold, that is 3 million. Disposal is 3,000. Now this sale proceed is not relevant data for us because we are supposed to calculate addition. Then we have revaluation of positive how much? 2 million. That is addition. Okay. Then provision is 4,004,000. Okay. Now once we are doing reversal working, signs will be changed. So 23,400 plus minus 4,000 plus 2,500 plus 3,000 minus 2,000 minus 14,400 is equal to 8,500. This is your addition. Now we can counter verify 14,400 plus 8,500 plus 2,000 minus 3,000 minus 2,500 plus 4,000 is equal to 25,000. Oh, there is a mistake. Look, 23,400 minus 4,000 plus 2,500. This is typo mistake. 23,400 minus 4,000 plus 2,500 plus 3,000 minus 2,000 minus 14,400, 8,500. So 14,400 plus 8,500 plus 2,000 minus 3,000 minus 2,500 plus 4,000 is equal to 23,400. So 8,500 is our addition. We use just that performer. So our answer is 8,500,000. Now next question is, at 1st October 2004, BK had accrued interest payable of 12,000 during the year ended 30th September. Now this is 1st October 2004. This is opening balance. PK charged finance cost of 41,000 to its statement of P&L, including unwinding a discount relating to provision stated at its present value of 150,000 at 1st October. The closing balance on accrued interest payable account at 30th September 2005 was 15,000 and BK has discount rate of 6%. There are two possibilities. One way is we will make it T account. So opening balance is a liability 12,000. Okay. Now balance brought down. Balance carried down 15,000. Now the charge in your SFP for that purpose journal entry is it is statement of profit and loss. Here how much it is? 41,000. But against that there is unwinding of discount. So unwinding is here because it's a non-cash item. 150,000 times interest rate is 6%. So 150,000 times 0.06, it is 9,000. Okay. So this 9,000 here, the balancing figure is cash paid, which is 41,000 plus 12,000 minus 15,000 minus 9,000 is equal to 29,000. One way is we will make T account. Other way is we will use pro forma, which is balance brought down 12,000 plus expense, interest expense, which is 41,000 minus unwinding, which is 9,000. We calculated 150,000 times 6% minus balance carried down, which is 15,000. And then we have this balancing figure. 12 plus 41 minus 9 minus 15 equals to 29,000. So our answer is B. Either we can use this T account format, either we can use this pro forma format. Then the following balances were extracted from N's statement of financial position as at 31st December. So this is again preceding year data. Preceding year, which will be used as opening balance. Deferred taxation and current tax payable. Then we have extracts of statement of profit and loss, where we have income tax expense. Requirement is tax paid. Again, either we can use T format, which is opening balance. We will add both 106 plus 27. 106 plus 27 is equal to 133. brought down balance, then carried down balance is closing balance, which is 38 plus 119, 157. Statement of profit and loss charge is 122. So balancing figure is your tax paid, against which we will use cash. So 133 plus 122 minus 157 is equal to how much cash paid is 98,000, or we can use pro forma. For that purpose, balance brought down, which is sum of both 133 plus tax expense, which is in SPL, 122 minus balance carried on, which is closing balance, which is sum of these two, 157. So this is tax paid, which is equal to 98. So it is 98,000. Then IAS 7 statement of cash flow sets out the three main headings to be used in statement of cash flow. Which two of the items below would be included under the heading cash flow from operating activities according to IAS 7? Now keep in mind, when we are talking about cash flow from operating activities, over there either cash generated from operation and the second performer, both is the part of cash flow from operating activities. Tax paid, purchases of investment, loss on disposal of machinery, and purchase of equipment. Yes, first one, tax paid, we subtracted from cash generated from operation, and loss on disposal we added back under the calculation of cash generated from operation. These two, purchase of investment is part of investing activities, and purchase of equipment is also part of investing activities. So our options are option A and B. C. Option A and C. Then during the year to 30th July 2007, Samarti Pants made a profit of 37,500 after accounting for depreciation of $2,500. During the year, non-current assets were purchased for 16,000, receivable increased by 2,000, inventories decreased by 3,600, and trade payables increased by 700. What was the increase in cash and cash balance during the year? Now keep in mind, these are all the activities for the year. Now, opening profit. Profit after accounting for depreciation. This is profit before tax. PBT, how much we have? 37,500. We have determined that depreciation, all expenses we are supposed to add back, which is 2,500. Now, during the year, non-current assets were purchased. This is part of investing activity, and this is operating activity. But here, because we have very small data, so we will do all the things here. So purchase of non-current asset is outflow. We are supposed to subtract it, which is 16,000. Then receivable increased by 2,000. I discussed earlier that if in your current assets there is increase, that would be outflows. In debtors, how much? 2,000. If there is decrease in your current assets, like decrease in inventory, that is your inflow. which is 3600. This is outflow. Outflows will always be shown in brackets. Then trade payable increased. There is inverse relationship between the treatment of current assets and current liability. So increase in payables will be your inflow. How much that is? 700. Now the result would be your net increase in cash or cash equivalent. 37,500 plus 2,500 minus 16,000 minus 2,000 plus 3,600 plus 700, which is equivalent to 26,300. Option D is the right answer. Now, this is the scenario. The assistant accountant of Cooper has started work on the statement of cash flows for the year ended 31st December 2008. Completing a draft of cash generated from operations is shown below. Profit from operation, depreciation, release of government grant, profit on disposal of PPE, increase in inventories, decrease in trade and other receivables, increase in trade and other payables, and cash generated from operation. So he has given you the cash generated in operation, but there are some mistakes. In addition to this, that assistant had seen that the balance of property was 39.5 million at 1st January opening balance and 29 million at 31st December 2008 closing balance. There was no addition of property. So there was a disposal. There was also deferred income balance relating to government grant of 6 million at 1st January and closing balance was 8 million. Now, from this data, we are supposed to do the question. What method has Cooper assistant accountant used to calculate the cash generated from operation? That is indirect method, as I discussed earlier when we talked about the performer. This is very simple answer. Then, in relation to the calculation of cash generated from operation, select the two cells which contain errors made by assistant. No, depreciation added back, release of government grant. Now, release of government grant. This is income that we are supposed to subtract, non-cash income, but he added back. So first mistake was this. Then profit on disposal of gain, disposal of property. Yes, we are supposed to subtract. It should be like this, but that was the first mistake. And increase in inventory. Yes, outflow. Decrease in trade and other receivables. This is again mistake. Because when there is a decrease in asset, that is current asset, that is inflow, but he showed it outflow. So these two items, release of government grant and decrease in trade and other receivables, he incorporated in the wrong way. So we highlighted these two. Then how much would be recorded in Cooper's statement of cash flow in relation to sale of property? Again, we will use that performer. For that purpose, we will go at our data. So, balance brought down, which is opening balance, that is 39,500 plus addition. There was no revaluation, minus disposal. Now he is saying uh, no addition during the period and no revaluation, etc. And that is the close, then minus depreciation and then closing balance. So there was no addition. How much depreciation we have, which is 4600, and after that how much closing balance we have, that is 29,000. So we will do the backward working. 29,000 minus 40 plus 4600 minus 39,500. So it is how much? 5,900. We can counter verify it. 39,500 minus 5,900 minus 4,600 equals to 39,500 minus 5,900 minus 4,600 equals to 29,000. Or we can also use its T account of PPE carrying value, because it is an asset opening balance on debit side. Balance brought down 39,500. No addition, no revaluation, nothing on debit side. Credit side, depreciation 4,600, disposal, balancing figure, then balance carried down 29,000. So if we will balance out both sides, it would be 39,500, 39,500. So 39,500 minus 29,000 minus 4,600 equals to balancing figure 5,900. So we can use either T account, we can use either performer. So its answer is 5,900,000, which is option D. Then what will be recorded as receipt of government grant in the year? Again, we will move to the data. Now, for receipt of government grant, we can use either T account. So we have balance brought down of government grant, which is there were a deferred income balance related to 6 million opening balance, and balance, we have balance carried down, that is 8 million. Closing balance, that was our opening balance and that was closing balance. And grant in our SPL, release of government grant, how much that was? 1,400. And it would be on your debit side here, 1,400. Now this is balancing figure, which is cash. This is SPL chart. So 9400 minus 6000, it is 3400 are the performer. Balance brought down how much? 6000. Sorry, balance carried down 8000 plus cash received plus sorry, income statement charge, which is 1400 minus balance brought down, which is 6000 and equals to cash received 3400. So our answer is 3400. Then, corporate assistant accountant has been studying statement of cash flow and is unsure whether the information contained in the study material is true. Which, if any, of the following statement is true? Intangible assets will have no impact on statement of cash flows as they have no physical terms. This is wrong statement because this logic is wrong. There is a possibility we have discussed under IAS 38 that sometime we may have purchased intangible assets. It means once we are purchasing, there is a possibility of cash outflow. So they may have impact on your statement of cash flow. So this is wrong statement. Okay. Now, this is wrong statement. Then statement 2, a right issue of shares will increase cash flows from financing activity because yes, it is correct statement because bonus issues are non-cash items. There is the element of bonus in right issues, but you are receiving some cash because right issues are issued, shares issued at price lower than your market price of shares, but higher than your nominal price. So cash element is there, and through that there is an inflow of cash flow from financing activities. So statement 2 is true. So our answer is B, that statement 2 is correct. Okay. Thank you very much, guys, for your time. This was all about for today's session. We have talked about how to prepare statement of cash flow using indirect method, and we have solved some past exam questions of section A and section B. In our live session, we will talk about how to prepare statement of cash flow for section C. Thank you very much.